Hey there, financial friends, losing money because you want to invest but too lazy or not willing enough to go through the stock market madness. Today, we get into the world of mutual funds. They are friendly neighbor of the investment world, while almost so walk up and ask for help. So, let's take an in-depth look at mutual funds basics and how they can align with your investment objectives. The obvious question then becomes, what is a mutual fund? Think of this as a giant community piggy bank where everyone is contributing some money. The money you deposit in this piggy bank goes under the control of investment experts who then use that to buy various things, any combination of stocks, bonds, and other investments. A mutual fund is like this giant diversified piggy bank. When you invest in a mutual fund, that's pretty much what you're buying into. Actually, no, if by picking your own stock rates cost more than the 1.3% you pay for a mutual fund. You see, it's all about diversification and specialization. A mutual fund pulls together your money with that of other investors and sends it out to buy thousands of different investments. That is diversification, and it would be the equivalent of not putting all your eggs into one basket. Since one investment might not outperform, the others could mitigate any drawdowns. Let's look at an example. Say you have $1,000 to invest. If you work in one company, it's like putting all the eggs stuck into one basket. However, say you invested that $1,000 into a mutual fund. It might be going to 50 or more different companies. You want to spread the risk out a bit, so if one company has a stinker of year, you aren't wet. Professional management is also a big advantage of mutual funds. The fund is managed by seasoned investors who have determined what to buy and sell. They research, look at trends in the market, and move around what their fund is holding, which means you do not need to spend hours upon end studying financial reports or market movement. It allows small investors access to a diversified portfolio akin to mutual fund. All you need to get started is a little bit of motivation. Most funds allow you to start with even just a few $100s, and if there is no large saving in the hands of a common man, then it will help more such people to incline towards investment. Now, we will discuss different types of mutual funds. Stock funds, which besides invest in company shares, they invest in debt security. Investment balanced funds combine stocks and bonds. For example, index funds mimic the performance of a defined market benchmark. Think S&P 500. There are different levels of risk and return associated with each type of fund. Stock funds, on the other hand, often have higher returns over time, but are also riskier. Whilst bond funds tend to be less volatile, they can also potentially grow slower than stock. While the right one for you will depend on your financial goals and tolerance for risk. This is by no means an exhaustive list. Mutual funds, on the other hand, hold an advantage in terms of liquidity. This entails you can often sell your shares and receive back money quickly. Most funds will let you sell on any business day, but having that flexibility can really come in handy if you need to get money. Mutual funds also comes with regular reporting. You'll receive regular notifications with the performance of your fund and what it's invested in. Being transparent in nature, it assists you to keep better informed about your investment. Fees are something to remember as well. Mutual funds have to fees in order or protect these costs. These may include management costs or bad business spreads. It is very important to be aware of these fees, as they can impact on how much you make. Fees, however, are higher for some funds than others. In general, actively managed funds, meaning managers hand-select investments, have higher fees than passively managed funds like index funds. Be sure to check the expense ratio of a fund, which describes how much in fees each year you will lose as a percentage of your investment. How to begin with investing in mutual funds? The first step would be to open an account with a brokerage or directly with a fund company. Mutual fund investments, these are also offered by almost all banks. You can sign a few documents, show some ID. After you set up your account, then the next step is to select which funds are best for you. You might want to consider talking to a financial advisor or doing research. Check the historical performance of that fund, but as anything, past performances are not indicative here. Think about the fund buying philosophy and its alignment to true north. The money comes from your bank account, and you are typically able to set up automatic investments so that the transfer can take place regularly without further intervention. It is a brilliant way of growing your investment with time and without any further thought. Dollar cost averaging is a method some people employ. The principle for this investment strategy is to invest a consistent dollar amount over regular intervals of time, regardless of what the market may or not be doing. In general, this can be used to moderate the worst of market volatility over time. Electronic transfer. It must be noted that just like any investment, mutual funds are subject to risk. Investment value can rise or fall. That is why it is so important to consider the investing horizon and the level of risk you are ready to take on when selecting funds. We think mutual funds are a good option to invest for retirement. The vast majority of workplace retirement plans, like 401ks for example, only offer a menu of mutual fund options. Some mutual funds can be used in an individual retirement account era as well. Investors with other goals, that is saving a child's education or house down payment, can benefit from mutual funds as well. But remember, factor in your time horizon. When will you need this money? As a general rule, the longer you have to invest your money, the more risk you can afford to take. So there you have it, a basic overview on mutual funds and some of their advantages. A convenient way for early stage investors to get exposure and benefit from the professional management of a diversified set of assets. Just remember that investing is going to carry some level of risk. So make sure you research and think about it in accordance with your personal finances. If you have found this video useful, please leave a thumbs up and share with anyone else who might want to learn more about investing. Don't forget to subscribe for more financial tips and insights. Image for posts, thank you, and to Responsible Finance watching.